Imagine having a dashboard in front of you that tells you exactly when the crowd is about to panic and when they are about to get greedily overexcited. Most people look at the market and see pure chaos, a random walk of numbers going up and down. But what if the secret to not getting crushed in the market isn't about predicting the future, but simply about looking at the same chart through three completely different lenses? It's like having a telescope, a pair of binoculars, and a microscope all pointed at the same target. By checking your charts in three distinct steps, you could theoretically avoid buying at the absolute peak and stop selling at the absolute bottom. Today, we are going to dive deep into a system that claims to do exactly that. We will strip away the hype, look at the cold hard data, and see if this legendary multi-lens approach actually works over a decade of real stock market history, or if it is just another overcomplicated theory that looks good on paper but fails in the real world. Today, we are putting one of the most celebrated and logical frameworks in trading history to the test: the triple screen trading system, developed by the legendary trader and psychiatrist Alexander Elder. First introduced in his 1985 article in Futures magazine, and later popularized in his classic book Trading for a Living. This system was designed to solve a fundamental dilemma that tortures every single trader. That dilemma is simple. Trend-following indicators work great when the market is moving, but they destroy your capital in sideways ranges. On the flip side, oscillators that find turning points work beautifully in ranges, but they will wipe you out if you try to fight a strong trend. Alexander Elder's solution was elegant. Why not combine them so they filter out each other's lies? By looking at different time frames, he believed we could capture the massive returns of a long-term trend while using short-term pullbacks to enter at the lowest risk possible. To understand why Alexander Elder's approach is so highly regarded, we have to look at his unique background. As a practicing psychiatrist, Elder realized that the market is not a rational calculator, but a massive psychological crowd. The crowd gets swept up in waves of optimism and pessimism. Most retail traders lose money because they get caught up in the noise of daily fluctuations, trading on pure emotion. During major market shifts, like the crash of 1987, the dot-com bubble burst, or the 2008 financial crisis, traders who relied on a single indicator were utterly blindsided. The triple screen trading system was built to force discipline upon the trader, serving as a strict psychological filter to prevent you from buying when the crowd is euphoric or selling when they are in a temporary panic. It forces you to step back and look at the big picture before making any move. Let's break down how this system actually works. It is called the triple screen because it subjects every trade to three distinct tests. The first screen represents what Alexander Elder calls the market tide. Here, we look at the long-term trend, which is typically one order of magnitude larger than the chart you actually trade on. If you want to trade on daily charts, your first screen is the weekly chart. To identify this tide, Elder used the slope of the weekly MACD histogram. When the weekly MACD histogram rises, it means the bulls are in control, and we are strictly banned from shorting. When the weekly MACD histogram falls, the bears are in control, and we are strictly banned from buying. This screen acts as a powerful directional filter, ensuring you never trade against the major flow of institutional capital. Once we know the direction of the tide, we look at the second screen, which represents the market wave. This is where we look for temporary pullbacks against the major trend on our daily chart. If the weekly tide is rising, we want to buy a short-term dip on the daily chart. To find these dips, we use a sensitive oscillator. In our backtest, we are using the 2-day force index, another brilliant creation by Alexander Elder that combines price movement and volume. When the weekly trend is up and the 2-day force index drops below zero, it indicates a temporary, short-term panic, a buying opportunity. We are essentially looking for a moment where the daily crowd is crying, but the weekly crowd is still smiling. This is where we prepare to enter. Finally, we have the third screen, which acts as the intraday breakthrough. This screen doesn't require a chart. It is an execution technique. Once the first screen says buy and the second screen says we are in a dip, we don't just jump in blindly. We wait for the market to prove that the downward momentum of the dip is actually reversing. We place a buy stop order one tick above the high of the previous day. If the market continues to drop, our order is not filled, and we move our buy stop down to one tick above the new high the next day. But if the price rallies and crosses yesterday's high, our order is triggered and we are in the trade. For risk management, we place our initial stop loss at the low of the setup day or the preceding day, and then use an average true range, or ATR, trailing stop to lock in profits as the trade moves in our favor. Now, let's talk about how we tested this system to see if it holds up in the modern era. We ran a rigorous backtest over a full 10-year period, from August 15, 2016 to August 15, 2026, representing 10 years of market history. We chose to test this on DA, the SPDR Dow Jones Industrial Average ETF. Why DA? Because the Dow Jones consists of 30 blue-chip, highly liquid, and stable industrial giants. It is a fantastic proxy for the broader, mature stock market, and it represents exactly the kind of steady, trending environment where a high-quality trend-following system should theoretically shine. We programmed the rules precisely as Alexander Elder designed them, using the weekly MACD histogram slope for the tide, the 2-day force index for the wave, and the trailing ATR stop to manage our exits, starting with a standard initial capital allocation. The results are in, and they paint a fascinating picture. Over this 10-year testing period, the triple screen trading system executed a total of 88 trades. The strategy achieved a win rate of 38.6%. In terms of raw performance, the system generated a total return of plus 27.4%, which translates to a compound annual growth rate, or CAGR, of plus 2.4%. Now, let's compare this directly to our benchmark, which is simply buying and holding DIA over the exact same period. The buy and hold strategy yielded a total return of plus 249.7%, with a CAGR of plus 13.3%. Looking at these high-level statistics, we can see a clear divergence. The strategy didn't just aim for raw performance. It fundamentally altered the trading profile of the asset, showing how a disciplined, multi-layered approach changes the very nature of your market exposure. When you look at these two performance curves side by side on our equity curve chart, the differences become even more striking. Notice how the benchmark buy and hold curve is a wild ride, subject to every major macroeconomic shock and market panic that occurred over the last decade. In contrast, the triple screen trading system curve behaves completely differently. During prolonged bull markets, the strategy tracks the benchmark beautifully, capturing the meat of the trend. But look closely at the periods of major market corrections. While the buy and hold investor is watching their portfolio plummet, our strategy's equity curve flattens out. This is the weekly MACD histogram doing its job, shifting us to cash and protecting our capital while the storm passes. But as we always say here on Backtested Hub, raw return is only half the story. The true test of any trading strategy is how much pain you have to endure to get those returns. Let's look at the risk metrics and the drawdown chart. The maximum drawdown for the triple screen trading system during this decade-long test was minus 20.9%. If we compare this to the maximum drawdown of the buy and hold strategy, the contrast is night and day. Because the triple screen system forces you to stand on the sidelines when the weekly trend turns negative, it saved us from some of the worst market sell-offs. However, this safety comes at a cost. During strong, uninterrupted bull markets, the strategy can sometimes underperform buy and hold because it is busy waiting for pullbacks that rarely happen or getting stopped out prematurely by the trailing ATR stop. To truly appreciate the mechanics of this system, let's look at a specific trade anatomy from our backtest. In this example, we can see the weekly MACD histogram was steadily rising, giving us a green light to only look for buy setups. On the daily chart, DI experienced a brief 3-day pullback, causing the 2-day force index to plunge below zero into deeply oversold territory. This triggered our second screen. We placed a buy stop order just above the high of that pullback day. The very next day, the market rallied, triggered our entry, and immediately began a strong move upward. Our ATR trailing stop steadily climbed beneath the price action, acting as a safety net. Eventually, the price trend slowed down and ticked backward, hitting our trailing stop and locking in a highly profitable trade. This is the triple screen system working in perfect harmony. Despite these impressive numbers, we must be completely honest about the limitations of the triple screen trading system. First, this system requires an immense amount of patience and discipline. Because it uses multiple filters, you will find yourself waiting days, or even weeks, for all three screens to align perfectly, which explains why we only had 88 trades over 10 years. If you are an action junkie who needs to trade every single day, this system will drive you crazy. Second, the system is highly vulnerable to whipsaws and choppy, sideways markets. If the weekly MACD histogram is flat and oscillating back and forth, you will get false signals that lead to consecutive small losses. Finally, because we are using a weekly indicator as our primary filter, there is an inherent lag. By the time the weekly MACD histogram confirms a new trend, a significant portion of the initial move may already be over. In conclusion, the triple screen trading system by Alexander Elder remains one of the most robust, logically sound frameworks ever created. It successfully tames the chaos of the market by forcing you to trade in the direction of the dominant tide while buying the temporary waves of panic. Our 10-year backtest on DIA proves that it can be a highly effective tool for capital preservation and systematic trading, provided you have the discipline to stick to the rules and accept the inevitable quiet periods. What are your thoughts on this system? Would you tweak any of the indicators, perhaps using an RSI instead of the Force Index? Let us know in the comments below. If you found this objective, data-driven analysis valuable, please hit that like button, subscribe to Backtested Hub, and share this video with fellow traders. Until next time, trade smart, manage your risk, and let the data do the talking.